What happens when the most powerful voice in finance hints at a major shift, and the market responds not with a whimper, but with an absolute roar?
Yeah, it's quite something to see.
You might think it's just another chaotic day on Wall Street, but Friday, August 22nd, 2025, well, it was anything but typical. We're talking about a truly powerful rally in U.S. equity markets.
The really significant
A
one.
rally that didn't just inch up, but decisively snapped a 5-day losing streak. And all this euphoria came thanks to Federal Reserve Chair Jerome Powell's highly anticipated speech at the venerable Jackson Hole Economic Symposium.
Always a big one on the calendar.
Today, we're taking a deep dive into your comprehensive stack of sources to unpack this truly pivotal day. We'll go far beyond the surface headlines to really understand why the market reacted with such intensity,
Right. Get under the hood a bit.
what Chair Powell actually said between the lines, and what the reverberations of this moment mean for everything from your individual tech stocks to, well, the intricate fabric of global economies. Our mission, really, is to give you that shortcut to being well-informed, armed with those surprising facts, and the crucial context that only, deep research provides.
And we're going to try and connect the dots across multiple asset classes, from equities to bonds, commodities, the works. We'll look at the underlying mechanics that drove these massive shifts.
The how behind the what.
Exactly. And importantly, we'll explore the subtle signals that often precede and then, power these major financial movements. Get ready for some genuine aha moments about how seemingly abstract macro events ripple through every single corner of the market.
I'd like aha moments.
This isn't just about what happened. It's about understanding the why and the how, which I think is the true value of doing this kind of in-depth research.
Absolutely. And you provided us with an incredible foundation for this deep dive. A stack of in-depth market reports, a granular look at the data, even some critical geopolitical context.
A good starting point.
Our mission, as we mentioned, is to distill these into the most critical, actionable insights for you. Now, set the scene, and it's a crucial scene setter. Markets entered Friday on an absolute knife's edge.
Yeah, the tension was palpable.
We'd just experienced 5 straight days of losses, and investors were absolutely on high alert, riddled with anxiety about persistent inflation and, frankly, the grim specter of a higher-for-longer interest rate regime dominating the economic landscape.
That was the big fear, wasn't it?
Totally. This pre-existing tension and uncertainty, as our sources really highlight, is absolutely crucial for understanding the sheer magnitude, the almost explosive nature of the rally that followed.
Right. Without that context, it's just another strong day.
Exactly. With it, it's a potential policy pivot that really moves markets. 1.1, the electric anticipation. Okay, let's truly unpack this. Before the market euphoria, before the celebration, there was this palpable, almost suffocating tension hanging over everything. Can you take us back to that exact moment? Paint a picture of the atmosphere leading up to Powell's highly anticipated speech. What were the undertones investors were feeling?
Well, the atmosphere, as described by your sources, it was really thick with anxiety. You can almost imagine the collective breath-holding across trading desks globally.
Yeah, waiting for 10 a.m.
Exactly. The S&P 500, our broad market barometer, had actually fallen for 5 consecutive days.
5 days straight, you said.
Yeah, 5 days. And this wasn't just a minor blip. It was its first such losing streak since January. That gets headlines. It unnerves investors.
Sure does.
And this wasn't like random market jitters either. It was fueled by very specific recent economic data that had really intensified anxieties about inflation and, consequently, the duration of high interest rates.
What kind of data are we talking about?
Well, we had seen a stronger than expected Philadelphia Fed index, for example, suggesting manufacturing wasn't cooling as fast as some hoped.
Okay.
Then the S&P Global PMI, another key measure of economic activity, that also came in hotter than anticipated.
So, signs of resilience, but maybe the wrong kind of resilience if you're worried about inflation.
Precisely. These data points collectively hinted that the economy might be too resilient, giving the Fed reason to maintain a restrictive stance, keep rates higher for longer.
Got it.
So the week was marked by these modest but steady declines, hitting the previously high-flying technology sector particularly hard. Every single eye was on Jackson Hole.
And it wasn't just any speech, was it? The Jackson Hole Economic Symposium carries this almost mythical historical reputation for being the platform where major watershed policy shifts are often subtly, or sometimes not so subtly, signaled. That history must have amplified the tension, right?
Absolutely, and that historical context, that's something only deep research really brings out, isn't it? It's key to understanding the fever pitch of anticipation. Jackson Hole isn't just an academic conference. It has served as the stage for truly pivotal moments in monetary policy. You think back to Ben Bernanke hinting at quantitative easing, or Powell himself recalibrating the Fed's inflation framework in years
These
past.
aren't just throwaway remarks.
Not at all. These aren't just speeches, they're often carefully choreographed signals. Investors weren't just looking for Chairman Powell to read a prepared statement. They were scrutinizing every word, every pause, every nuance,
Looking for clues.
looking for that definitive signal that could redefine the entire economic landscape and set the future trajectory of monetary policy. The real aha isn't just that markets react to Powell, but that they essentially front-run policy.
Trying to guess the next move.
It's a high-stakes game of anticipating the Fed's next move, not just reacting to data. Think of it like a chess master's subtle pawn push. It doesn't change the board immediately, but it signals a fundamental shift in strategy that the opponent, in this case the market, has to react to now.
That's a great analogy.
And that's where the value of deep research comes in. Understanding the historical patterns of these signals, reading the tea leaves based on past communications. 1.2 Powell's commentary, a masterclass in nuance.
Then, right at 10 a.m. Eastern Time, it was like a collective gasp across trading floors, wasn't it? And the market absolutely exploded. Our sources are universally calling it a dovish pivot.
They are. The language was quite consistent across the analysis.
But for someone who wasn't glued to the screens, what were the absolute key phrases, the signal words that genuinely triggered such an immediate and dramatic shift in sentiment? What did Chair Powell actually say that flipped the script?
While the market's palpable apprehension genuinely gave way to outright euphoria right around 10 a.m. when Powell began his address. His commentary, as highlighted by multiple reports you've provided, truly marked a distinct and material shift in tone compared to previous, often more hawkish communications.
So real change in vibe.
Definitely. He effectively gave the market the dovish signal it had been so desperately hoping for. The core of this dovish interpretation rested on Powell's explicit acknowledgement of evolving economic risks.
Evolving economic risks.
Yeah, that phrase itself was a departure, indicating a broader consideration beyond just inflation. He then specifically noted a discernible cooling trend in the labor market.
Ah, the jobs piece.
Right. Referencing July's disappointing jobs report, which, remember, many had initially dismissed as maybe just an anomaly, and highlighting that the 3-month pace of job gains was now the slowest since 2020.
Wow, since 2020, that's a significant slowdown.
It is, and that was a critical data point that seemed to shift his tone. He wasn't just vaguely acknowledging a slowdown, he was directly linking it to the Fed's dual mandate, specifically the employment side, and giving specific data points to support his concern.
That is a significant shift from the relentless focus on inflation we've seen for so long.
Precisely. And crucially, the phrase that truly landed like a thunderclap, the one everyone picked up on, was when he stated that upside risks to inflation have diminished.
Oh, okay. That's the big one.
That's the one, exactly. That right there was the key. It signaled to investors that the central bank's primary concern might finally be shifting away from its intense, singular focus on price stability and moving more towards its employment mandate.
So rebalancing the priorities.
Exactly. This recalibration of the Fed's reaction function, essentially how it prioritizes and responds to economic data, was the fundamental catalyst for the day's rally. His commentary largely validated the market's growing narrative of a precautionary insurance cut in September.
An insurance cut. Let's
Correct.
explain that a bit more.
Well, this wasn't framed as a desperate move to combat an impending recession, but rather as a strategic maneuver to preempt a more significant economic slowdown, especially given the recent softness in employment data. It's a very nuanced distinction
But an important one.
that the market immediately latched onto. An insurance cut rather than hitting the panic button in the face of a crisis.
Okay, that makes sense. But this sounds like a delicate tightrope walk, doesn't it?
Yeah.
How did Powell manage to deliver such a dovish message without completely boxing himself into a corner, making an ironclad promise he might later regret?
That's a really important question.
It truly felt like a masterclass in managing market expectations.
It really was, and this is where the deep research into central bank communication truly shines. How did Powell deliver this dovish message without boxing himself in? It was, as you rightly point out, a masterclass. While unequivocally dovish in its implications, his speech maintained a crucial degree of ambiguity and conditionality.
Leaving wiggle room.
Exactly. He reiterated the Fed's data-dependent approach, explicitly stating that the committee would be closely watching the next Consumer Price Index, or CPI, reading and the upcoming jobs report before its critical September 17 decision.
So he basically said, we're leaning this way, but these next reports could change our minds.
Pretty much. He essentially gave the market the why for a potential cut without giving the definitive when or how much. He explicitly left himself an out, a path to pivot again if the data dictates. It's almost like he gave the market a roadmap for where they might go without explicitly buying the ticket himself.
Clever. Strategic flexibility.
Crucial strategic flexibility. It allows the market to price in a high probability of a rate cut, which of course fuels the rally and eases financial conditions,
Which do they want?
while simultaneously giving the central bank an out should the upcoming data come in unexpectedly strong. This preserves their credibility and avoids making an irreversible commitment. The ultimate insight here, I think, from the research is that Powell, through his carefully crafted ambiguity, flipped the burden of proof.
How so?
Before Friday, the Fed needed compelling reasons to cut rates. After Friday, they now seem to need equally compelling reasons not to cut. That subtle psychological shift is where billions move. And it's a playbook central bankers often employ when trying to guide expectations without committing prematurely. By using phrases that lay the groundwork for renewed easing, rather than outright promising it, Powell successfully threaded that needle between spooking the market with hawkishness and trapping himself with an unconditional promise.
That level of communication detail, analyzing every phrase, that's what the deep research in your sources really drilled down into, right?
Absolutely. Word by word, almost. 1.3 quantifying the market impact of the speech.
So this nuanced speech led to an immediate explosion of activity. What does this all mean in concrete terms? How quickly did the market react? And more importantly, how did our sources quantify that dovish pivot in measurable terms? How do we put numbers to that feeling of relief?
Yeah, the market's reaction was not only immediate, but also incredibly decisive and highly quantifiable. It gives us a clear illustration of how quickly expectations can shift.
So the odds of a cut changed.
Dramatically. The probability of a 25 basis point rate cut at the September meeting, as implied by trading in the federal funds futures market, that's where traders bet on future Fed rates, it surged.
From what to what?
It went from hovering around 70% earlier in the week, which is strong, but not, a done deal,
Right, still some doubt.
to nearly 90% in the immediate wake of the speech.
Wow. 70 to almost 90%, just like that.
Just like that. This dramatic repricing of short-term interest rate expectations was the fundamental driver of all subsequent asset movements we're about to discuss. It's a direct, almost instantaneous reflection of investor belief in a policy shift.
And there was precedent here too, wasn't there, from last year's Jackson Hole?
That's a great point, and the sources highlighted this. This year's address gains even further weight when viewed in the context of last year's Jackson Hole meeting, where Powell also hinted at the beginning of a new easing cycle.
So the market had seen this movie before, in a way.
Exactly. This established a powerful historical precedent for the market's interpretation of his remarks as a credible policy signal. That's the power of these carefully chosen words. This single event essentially raised the bar for not cutting rates, shifting the burden of proof onto future economic data. It's a powerful psychological and financial maneuver.
A maneuver that astute investors,
Having done their deep research into past Fed communications, would immediately recognize and act upon. 2.1 headline performance snapping the losing streak.
okay, after all that intense anticipation, the U.S. markets responded with undeniable force, a true relief rally. Give us the snapshot. How did the major indices perform after that speech, and how significant were these moves?
Well, after a challenging week characterized by that intense risk aversion and 5 straight days of losses for the S&P 500, the major U.S. equity indices truly reversed course with remarkable force.
Not just a little bounce back.
No, this wasn't merely a modest rebound. It was a powerful, broad-based surge that effectively erased the week's declines and signaled a significant immediate shift in investor sentiment. The collective sigh of relief was almost audible across the trading floors, and it turned into palpable buying pressure.
That's truly impressive, especially after such a rough week. Let's look at the numbers for our listeners. How did the big indices finish?
Okay, the Dow Jones Industrial Average, our industrial bellwether, it really led the charge among the major averages, closing at 45,696.86. That was a substantial gain of over 911 points.
And 911 points. Wow. percentage-wise?
A robust 2.03% for the day. The S&P 500 index, which many consider the truest broad market benchmark, finished the session at 6,463.76. That was a climb of nearly 94 points, a solid 1.47% gain.
Okay, and the NASDAQ. Tech must have loved this.
Oh, yeah. The technology-heavy NASDAQ composite, which had been at the forefront of the week's pullback due to its sensitivity to interest rates, it also rallied strongly, surging about 1.6% to bring it to around 21,437.91.
So solid gains across the board.
Absolutely. These weren't incremental moves. Our sources noted them as decisive, broad-based advances that caught many off guard with their sheer velocity. This really underscores the pent-up demand for that dovish signal. 2.2 intraday action and technical significance.
Now, it wasn't just the final numbers on the scoreboard, but how the day unfolded, the minute-by-minute action that tells a real story of this shift, doesn't it? What was the moment-by-moment reaction like once the speech hit the wires at 10 a.m. ET?
Absolutely. The trading session unfolded as a clear, almost theatrical reaction to the day's pivotal event. It was quite dramatic. The market opened with only modest optimism.
Holding its breath still.
Yeah, stock futures were pointing to gains of a mere 0.2% to 0.3% in anticipation of the speech, reflecting that underlying uncertainty. This tentative start literally transformed into a full-blown aggressive rally immediately after 10 a.m. ET.
Instantaneous.
Pretty much. Our sources highlighted this as a direct and undeniable causal link between Powell's dovish commentary and the almost instantaneous surge in equity prices. It was as if a massive weight had been lifted, and capital, which had been cautiously sidelined, just rushed back in.
And from a technical analysis perspective, for those who follow the charts, what did this rally signify beyond just the price movements? Were there any key levels reclaimed or signals generated that the deep research pointed out?
Yes. From a technical perspective, the day's advance was particularly significant for the S&P 500. The sources made a point of this. On Thursday, the index had closed below its 20-day exponential moving average, or EMA.
Which is a key short-term trend line.
Exactly. It was around 6,381, and it was the very first time it closed below that level since August 1st. This was a concern for many technical analysts.
A potential warning sign.
It was. Friday's powerful rally, however, saw the index decisively reclaim this important level that's a technically bullish signal that reinforces the positive momentum shift and suggests renewed strength.
Okay, it took back that lost ground.
Right. Furthermore, the index successfully held above a critical support zone identified by analysts between 6,290 and 6,315. Holding that prevented what could have been a deeper technical breakdown and a further erosion of confidence.
So it bounced right where it needed to.
Pretty much. And if we connect this to the bigger picture, that 5-day losing streak leading up to the speech wasn't just random profit-taking. It represented active hedging and de-risking by investors ahead of a major catalyst.
People were nervous playing defense.
Absolutely. The force of Friday's rally was therefore significantly amplified by the rapid unwinding of these defensive positions, forcing investors to quickly cover their short positions and redeploy capital that had been moved to the sidelines.
A short squeeze element too, maybe?
Potentially, yeah. This isn't just about the numbers on a screen. It's about understanding the mechanics of how money moves, how expectations are built, and then either confirmed or dashed. Deep research helps us see those underlying currents, the flows of capital. 2.3 market breadth and sentiment beyond mega caps.
Now, a common concern, especially after periods where a few massive tech companies drive the market, is if a rally is truly broad-based or just a few big names pulling everything up, was this rally broad-based or was it another Mag 7 story? What does market breadth tell us about its overall health and potential sustainability?
That's a crucial question, and this is a key insight from our sources. The rally was characterized by its breadth.
Okay, good.
Meaning widespread participation across a diverse range of companies,
Yeah.
rather than a narrow advance confined to a few mega capitalization stocks. This is a vital distinction for the health of any bull market.
Why is that so important?
Well, it suggests conviction. The outperformance of small trap indices like the Russell 2000, which is often seen as a barometer for the broader U.S. economy,
Like a smaller company.
and the equal-weighted S&P 500, where every company contributes equally, not just the largest by market cap, further supports the narrative of a broadening market advance.
So not just Apple and Nvidia carrying the load.
Exactly. And what's truly fascinating here is that for much of 2025, market gains were indeed driven by a narrow cohort of AI-focused mega-cap tech stocks, creating a sort of haves and have-nots scenario in the market.
We saw that divergence.
A broadening of leadership, with small caps and value stocks outperforming, is actually a very healthy sign for a durable bull market because it implies investors anticipate the Fed's pivot will boost the broader economy, not just the tech sector.
That makes sense. It's a wider bet on recovery.
Precisely. This is crucial for you as a long-term learner, showing that the economic impact is expected to be widespread. Small cap stocks, being generally more sensitive to domestic economic conditions and borrowing costs, tend to lag significantly in a higher rate environment.
They get hit harder by rate hikes.
Yeah. Right. So the prospect of Fed rate cuts disproportionately benefits these smaller, more cyclically oriented companies because their borrowing costs become cheaper and their customer spending power potentially increases. So this rotation indicates genuine, deep-seated optimism for broader economic improvement, moving beyond just the big tech narrative. 3.1, the Fed Pivot Playbook in action. Leading sectors.
Okay, so this wasn't just a random rise across the board. Specific sectors surged, almost as if investors were following a pre-written script. You called it the Fed Pivot Playbook. What was this playbook in action, and which sectors benefited most directly from this dovish signal?
Yeah, the day's sector performance was truly a textbook execution of the Fed Pivot Playbook, a pattern we've seen in historical cycles when the market anticipates easing. The market's leadership reflected a direct and logical response to that fundamental shift toward monetary easing.
So capital flowed decisively.
Into sectors that benefit most from lower interest rates and an improved economic outlook. It's almost like observing economic theory play out in real time on the market ticker.
So, for example, what happened with the technology giants and communication services? We're often very sensitive to interest rates.
Absolutely. Primary beneficiaries, as our sources widely predicted, these are considered long-duration growth sectors.
Meaning their value comes from earnings far in the future.
Exactly. And the sharp drop in Treasury yields increases the present value of those projected future earnings. It's a core valuation principle. When the discount rate used to value those future earnings falls, their current valuation naturally looks more attractive.
So the math just works better for them.
Right. You saw mega-cap technology and tech-adjacent names posting significant gains across the board. Tesla, for instance, jumped nearly 6%.
Wow.
Alphabet and Amazon each added over 3%. Even chip leaders like NVIDIA and social media Titan Meta platforms both rose by approximately 2%.
Solid gains there.
And the strength was widespread within the technology complex. This was evidenced by a roughly 3% jump in the PHLX Semiconductor Index. That's our key barometer for the global chip industry, covering designers, manufacturers, everyone.
So broad buying in chips too.
Indicates broad-based buying in that critical sector, yeah.
And what about consumer-facing sectors, like consumer discretionary? That usually reacts strongly to signals about consumer health and borrowing costs.
Absolutely. Consumer discretionary, being an economically sensitive sector, was another major outperformer. Its surge was driven by investor optimism that lower borrowing costs will reinvigorate consumer spending, especially on big-ticket discretionary items.
Cars, homes.
Exactly. Things people often finance. Within that, the housing subsector surged significantly on the prospect of lower mortgage rates. Home builders such as Lennar and Toll Brothers advanced by more than 5%.
Big moves for builders.
Huge, signaling strong belief in a housing rebound. And the rally even extended to the entire housing ecosystem. Building materials supplier Builders First Source soared 8%.
8%.
And flooring company Mohawk Industries gained 7%.
Wow, the whole home improvement space lit up.
It did. Even the automotive sector, particularly EV manufacturers like Tesla and Rivian, jumped as investors anticipated that cheaper auto loans would stimulate demand for new vehicles. It's that domino effect of lower rates rippling through the economy.
Makes sense. And financials. They're always interesting when the Fed shifts gears because they sit right at the heart of the credit system. How did they react?
Financials, particularly banks, stand to benefit significantly from a Fed pivot that successfully engineers a soft landing for the economy, avoiding a harsh recession.
How does that work for them?
Well, a key mechanism here is the yield curve. A steeper yield curve where long-term rates are higher than short-term rates is generally good for banks.
Because they borrow short and lend long.
Exactly. Banks effectively borrow short-term money from depositors and lend it out long-term through mortgages and business loans. A steeper curve means a wider spread between their costs and their revenue. That widening gap directly boosts their net interest margins, or NIMs.
Makes lending more profitable.
Much more profitable. It's like buying flour cheap and selling bread for a higher profit. The bigger the gap, the happier the baker, or in this case, the banker.
Good analogy.
And of course, an improved economic outlook reduces the risk of loan defaults, which is always a significant positive for the banking sector's bottom line. Fewer write-offs, 3.2 lagging sectors, the risk-off rotation.
Okay, so we've seen where the capital rushed into the growth plays, the cyclicals, the rate-sensitive stuff. But in a dynamic market like this, money often flows out of one area to fund another. Which sectors felt the pinch, or at least lagged behind? And what does that tell us about the broader sentiment shift?
Yeah, in such a strong risk-on environment, defensive sectors predictably underperformed as capital rotated into more cyclical and growth-oriented areas of the market. It's the classic rotation.
So utilities, staples.
Exactly. While specific underperformance data for every single sector on the day is always a little harder to isolate in a broad rally like this, our sources confirm that sectors like utilities and consumer staples likely lagged the broader market's advance significantly.
And we saw some weakness there earlier in the week, right?
We did. We had already seen pronounced weakness in consumer-facing staples like Walmart and Costco on Thursday. That was attributed partly to some earnings disappointments, but also fears of higher rates depressing consumer spending on everyday goods.
So,
This really set the stage for a rotation out of these defensive names, which investors tend to flock to during uncertainty, and into discretionary stocks and technology on Friday when the outlook brightened.
selling safety, buying growth.
That's the move. The energy sector, which has actually been a year-to-date underperformer despite geopolitical tensions, also likely saw more muted gains compared to the market leaders.
So this clear rotation from defensive to cyclical names, it wasn't just noise.
No, our sources suggest it signals a genuine increase in risk appetite and a fundamental reassessment of economic prospects, not just a technical short-covering rally, although that might have played a part. For you, it shows the underlying currents of market psychology at play, which is critical for making informed decisions and understanding broader economic confidence. 3.3 year-to-date context, briefly.
Just to put this Friday rally in context for our listeners, what have been the year-to-date trends for some of these sectors? Have these leading sectors like tech been the stars all year, or is this a new development?
That's a good clarification. It's worth noting that communication services and technology have actually been the undisputed top-performing sectors for the year so far.
Driven by AI mania, mostly.
Largely driven by the ongoing excitement and investment around the artificial intelligence narrative, yes. So Friday's rally for tech and comm services built on an already strong foundation, further cementing their leadership for 2025.
Okay, so adding fuel to an existing fire there. What about laggards year-to-date?
Well, in stark contrast, the healthcare sector has been one of the worst performers year to date.
Really? Why is that?
It's been weighed down by a combination of factors, including uncertainty surrounding government policy, potential changes in reimbursement rates, concerns about rising medical costs, sort of a mix of headwinds.
So the Fed pivot, while maybe helpful on the margins, hasn't dramatically altered those bigger sector-specific concerns for healthcare yet.
Not yet, it seems. The broader year-to-date trends largely held, with Friday reinforcing the leaders. 4.1 European markets, modest gains, underlying concerns.
Now, the U.S. Fed's actions, as we know, don't happen in a vacuum. Its influence reverberates far beyond U.S. borders. How did global markets, particularly over in Europe, respond to this dovish signal from Chair Powell?
Yeah.
Was it a universal surge or more mixed?
Well, the dovish signal from the U.S. Federal Reserve certainly had a pronounced effect on global equity markets, but the magnitude of the reaction varied significantly by region, and that often reflects differing domestic economic conditions and challenges.
Right, local factors always play a role.
It's never a monolithic response, which is something deep research helps to clarify, showing the localized filters through which global news is processed.
Okay, let's start with Europe. Our sources describe their indices as closing with modest gains, which sounds, frankly, somewhat understated given the U.S. performance.
That's precisely the word used across the reports. Modest. European indices closed with these modest gains, having traded in a noticeably jittery mood for most of their session before Powell's speech.
So they were nervous too?
Very. The positive news from Jackson Hole provided a late session boost, helping the major bourses finish in positive territory, basically avoiding a decline. But the gains were small.
Give us some numbers.
The Euro Stoxx 50, a key benchmark for the Eurozone, closed up just 0.29%. Germany's DAX, Europe's economic powerhouse index, finished nearly flat, up a mere 0.01%.
Practically unchanged.
France's CAC 40 posted a gain of 0.19%, and the UK's FTSE 100 edged higher by only 0.04%.
So barely moving the needle compared to the U.S. Why such a muted reaction in Europe?
That's the important question the analysis raises. It really highlights the region's more severe underlying economic challenges, which couldn't be entirely offset by U.S. optimism.
Like what specifically?
Specifically, our sources pointed to a downward revision of Germany's second quarter GDP, showing a contraction of 0.3% quarter over quarter.
Ouch. Germany contracting.
Yeah, that's a stark reminder of the persistent weakness in Europe's largest economy. So the positive U.S. sentiment was probably sufficient to prevent a sell-off in Europe, put a floor under the market.
But not enough to spark a real rally.
Exactly. It couldn't fully ignite a major rally given their formidable domestic economic headwinds. 4.2 Asian markets, a more robust response.
But elsewhere, the reaction was stronger, it seems. China, in particular, had a remarkable day, which is significant given its own economic narrative recently, right?
Indeed. Asian markets displayed a much more robustly positive reaction than Europe, with China's performance being a global standout.
What happened in China?
The China Shanghai Composite Index surged a significant 1.45% to close at a new 10-year high.
A 10-year high. That's huge.
It is. This is not just a daily game. It's a major technical and psychological milestone. It suggests that the combination of recent domestic stimulus measures by the Chinese government and a more accommodative U.S. monetary policy is creating a powerful tailwind for Chinese equities.
So a mix of local support and favorable global conditions.
Exactly. And if we connect this to the bigger picture, a dovish Fed tends to put downward pressure on the U.S. dollar.
Right, weaker dollar.
And a weaker dollar is fundamentally beneficial for emerging markets like China. Why? Well, it can attract foreign capital seeking higher returns, and crucially, it makes servicing dollar-denominated debt cheaper for Chinese companies and the government.
Ah, that makes sense. Debt relief, effectively.
It's a classic example of global interconnectedness, showing how U.S. policy decisions directly impact financial flows and economic health thousands of miles away, a point clearly elaborated in your sources. This is something you can only truly appreciate with a deeper understanding of these macro currents. Fascinating. And other parts of Asia. Did they follow China's lead or have their own nuances?
Hong Kong's Hang Seng Index also posted a strong session, closing up 0.93%, reflecting that broader regional optimism. Japan's Nikkei 225, after some earlier volatility, recovered from its lows to finish the day with a slight but positive gain of 0.05%.
So positive across Asia, but China really stood out.
Definitely the leader on the day in that region. 4.3 indie market context. Parallel narrative.
In parallel, our sources mentioned some interesting developments in the Indian market as well, adding another layer to the global picture. What's the story there? Is it tied to the Fed or more local?
Yes, in a parallel narrative, the Indian market has also been exhibiting bullish characteristics, though driven by a slightly different mix of factors. It's not solely about the Fed pivot there.
Okay, what's driving India?
The Nifty index has staged a notable recovery from oversold levels over the past fortnight, reclaiming its 20- and 50-day exponential moving averages and sustaining a position above the psychological 25,000 mark, so technically strong.
And fundamentally.
Well, this technical strength seems underpinned by domestic factors. Our sources pointed to optimism around a prospective recalibration of the goods and services tax, or GST, regime, which could boost economic activity.
Okay, domestic policy optimism.
Right. And also a de-escalation in geopolitical tensions with China, specifically regarding border issues, which reduces uncertainty for investors in the region.
Ah, so less friction there helps sentiment.
Definitely. So while probably benefiting from the improved global mood created by the Fed, India also has strong internal drivers that are propelling its market forward. It showcases how diverse market forces can converge or sometimes run on parallel tracks. 5.1 macro-driven gainers, direct beneficiaries.
Okay, beyond the broad strokes of indices and sectors, let's zoom in on individual companies. This is where the deep research often gets really interesting. Who are the direct beneficiaries of the Powell pivot? The stocks that clearly rode this wave of optimism, and what kind of gains did they see? These are the names our listeners are often tracking closely.
Yeah, a wide array of companies rallied as direct beneficiaries of the Powell pivot and that resulting drop in interest rates, just as the Fed pivot playbook would suggest.
So hitting those same themes again.
Exactly. As we mentioned, the technology megacaps were primary movers. Tesla jumped nearly 6%.
Still impressive.
Alphabet and Amazon each added over 3%, while chip leaders NVIDIA and Broadcom, along with social media titan Meta Platforms, all rose by approximately 2%. Familiar names, big beneficiaries.
Right. And the housing sector, too, you mentioned.
Absolutely. The prospect of lower mortgage rates making homeownership more accessible really lit a fire under those stocks. This included major builders like Lennar and Toll Brothers advancing over 5%, building materials giant Builders First Source soaring 8%.
Still can't get over that 8% jump.
And flooring company Mohawk Industries gaining 7%. It was a powerful move.
And even crypto-related stocks got a boost.
That's
Seems like pure
significant.
risk appetite.
It does. They're often seen as a bellwether for pure risk appetite, and they certainly participated. Major cryptocurrency exchange Coinbase and Bitcoin hoarding software company MicroStrategy climbed more than 6% each.
Wow.
As risk appetite extended to digital assets and Bitcoin itself rallied in response to the dovish news, it's a complete cascade, from treasuries down to the most speculative assets, 5.2 company-specific gainers amplified by sentiment.
But sometimes a rising tide lifts certain boats even higher, due particularly to unique company-specific news, right? What were some of those standout performers that had individual catalysts amplifying the broader market sentiment? This is where deep research into individual companies really pays off.
You're absolutely right. This is where the granular details matter, and the sources highlighted a couple of really interesting ones. A great example of this is Intel, the venerable semiconductor manufacturer.
What happened with Intel? They've had a tough run sometimes.
They have, but Friday was different. Shares of Intel surged an impressive 6% to 7% in a standout move that went well beyond the general tech rally.
Okay, what drove that?
The primary catalyst here was an announcement from President Donald Trump that the U.S. government would take a substantial 10% equity stake in the company.
Whoa, the government taking a stake in Intel. Ow.
Yeah, big news. This development, reportedly structured as a conversion of grants previously allocated under the CHIES and Science Act into an equity position, provided a massive company-specific catalyst on top of the broader market tailwind.
Converting grants to equity. That's unusual.
It is. And what's truly fascinating here, and something our sources really highlighted, is how this signals a potential paradigm shift in U.S. industrial policy, maybe a more interventionist approach to securing critical technology supply chains, moving beyond just subsidies to direct ownership.
That's a huge potential change.
For you, it's a peek behind the curtain at how government policy, especially in strategic sectors, can create massive company-specific catalysts that profoundly impact valuations, entirely separate from, but definitely amplified by, broader market trends like the Fed pivot.
Absolutely fascinating. Any other individual standout gainers that caught the eye of our analysts?
Absolutely.
Ubiquiti.
The networking company.
That's the one. Network technology company known for its Wi-Fi and networking hardware. They were another one of the day's absolute top performers, soaring over 19%.
19%. What happened there? Must have been earnings.
Bingo. This massive gain was a direct result of the company reporting quarterly revenue of $759.2 million, which dramatically exceeded the consensus analyst estimate of $621 million.
Wow. Blew away the estimate.
Huge beat. That's a clear and significant earnings surprise driving exceptional performance. The market loves a good earnings surprise, and Ubiquiti definitely delivered one. 5.3 company-specific decliners battling the tide.
Now, even on a day of such massive, almost universal gains, some stocks inevitably fell. What does that tell us about the power of company-specific news, even against a truly strong market tide? It's a reminder that even a rising tide doesn't lift all boats indiscriminately, does it?
No, it certainly doesn't, and it tells us a lot about the importance of granular, fundamental research, even on days when macro factors seem to dominate everything. So who are the notable decliners?
Intuit, for example, the financial software company behind TurboTax and QuickBooks. They dropped between 5% and 6.4%, making them one of the S&P 500's biggest decliners and a real notable exception to the day's rally.
Despite the market ripping higher. Why? Did they miss earnings?
Actually, no. This is the interesting part. Despite reporting fourth quarter results that actually beat expectations on some metrics, the company issued a disappointing forward-looking outlook for both revenue and profit.
The guidance. That's what really matters.
Always. That's what investors are really focused on the future. Management even explicitly noted a loss of market share among lower-end TurboTax customers, a fundamental competitive concern that heavily outweighed the positive market sentiment.
So company-specific problems trumped the macro tailwind.
Exactly. Similarly, Workday, the enterprise software firm, also fell against the market trend, dropping between 3% and 4.5%.
And story there. Guidance.
Pretty much. Although Workday also beat earnings expectations for the quarter they reported, its forecast for the next quarter, Q3, came in slightly below Wall Street's consensus. Not a huge miss, but enough to disappoint.
Right. So it illustrates a crucial point for you as a learner. Even the most powerful macroeconomic tailwinds can't always overcome fundamental company-specific concerns, especially when it comes to future guidance and competitive positioning.
It's a stark reminder that even when the market is euphoric, you need to look at the granular details that deep research into corporate fundamentals provides. Can't just ride the wave blindly. 5.4 stocks in focused geopolitical headwinds.
And what about a bellwether like NVIDIA? It rose with the tech tide, certainly maybe around 2%, you said. But our sources indicate there were some whispers about specific challenges that bear watching. This highlights how complex the narrative for even a leading company can be, doesn't it?
Yes, absolutely. Even while NVIDIA's stock rose in line with the broader technology sector, its day included some company-specific headwinds that highlight ongoing and significant geopolitical risks. The gain was there, but maybe less than it could have been without this news.
Oh, the news. Specific to China again?
Yes. Reports emerged, confirmed by our sources, that the company had instructed some component suppliers to halt production related to its H20 AI chip.
The H20. That's the one designed specifically for the China market to comply with export rules, right?
That's the one. A less powerful version specifically designed to comply with U.S. export controls for sale in the crucial China market. The production halt reportedly reflects a troubling lack of demand.
Lack of demand. Why?
Well, the reports suggest Beijing has urged domestic companies not to use the H20 chip, citing evolving security concerns and, a push for indigenous Chinese alternatives.
The push for tech self-sufficiency in China.
Exactly. This highlights an ongoing and significant geopolitical risk for a key market leader like NVIDIA, whose sky-high valuation is heavily dependent on continued global AI adoption and market access, including in China.
So even as the stock goes up on Fed news, there's this undercurrent of risk.
Precisely. For you, it's a clear example of how macro-level geopolitical tensions directly impact even the biggest players, adding a permanent layer of complexity to market analysis that goes far beyond simple economic indicators. It shows how companies have to navigate these complex, often politically charged landscapes. Deep research has to account for geopolitics now more than ever. 6.1 fixed income, the first domino.
Okay, so the market's reaction wasn't just about stocks. It cascaded across everything from bonds to commodities and volatility. Where did this all begin? What was the first domino to fall, and how did it ripple through other asset classes?
Well, what's fascinating here and truly foundational to understanding the day's events is that the bond market reaction was really the first domino to fall.
Before stocks even reacted.
Almost simultaneously, but it's the purest reflection of interest rate expectations. The immediate and sharp drop in Treasury yields was the primary mechanism through which the Fed's dovish signal was transmitted to the broader market.
The bond market leads the way.
Often, yes. This foundational shift in the cost of money then allowed for the subsequent correlated moves across other asset classes. Any deep research into market mechanics really has to start with the bond market on a day like this.
So specifically, what happened with Treasury yields? You mentioned they fell, especially the benchmark 10-year. How dramatic was that move?
The yield on the benchmark 10-year U.S. Treasury note fell sharply. It closed at 4.258%.
Down from where?
Down significantly from the previous day's close of approximately 4.33%. This wasn't just a minor fluctuation. It marked the largest single-day yield decline since August 1st.
Wow, biggest drop in weeks.
And it decisively snapped a 2-week streak of rising yields that had been a major source of investor anxiety.
So that upward pressure on yields just broke.
Completely reversed, at least for the day. And this drop in the risk-free rate is fundamentally crucial for stocks.
How so again? Remind us.
It boosted equity valuations primarily by lowering the discount rate applied to future corporate earnings. Basically, future profits become worth more in today's dollars when the interest rate used to discount them back is lower.
Okay, the valuation math improves.
Right. This provides the mathematical and fundamental support for the stock market rally we discussed. It's the engine room of the market's repricing on a day like this. 6.2 commodities mixed signals.
How did commodities react to all of this? Was it a clear trend there too, or maybe a more complex picture given the various forces at play in that market? Commodities are often seen as indicators of real economic activity, but they're also heavily influenced by geopolitical factors, aren't they?
They are, and the picture in commodities was definitely more mixed, particularly in energy. The energy market's reaction in particular was actually more muted than one might expect from such a strong risk-on day.
Really? You'd think optimism would boost oil demand expectations.
You might, but geopolitical factors seem to serve as the dominant driver for WTI crude oil on this specific day. Futures traded with only a slight upward bias, closing near $63.65 per barrel.
So barely moved. Why?
Well, prices found support primarily from fading optimism for a near-term ceasefire between Russia and Ukraine. That concern about supply disruption seemed to outweigh broader economic demand concerns that might have otherwise pulled prices lower if the economic outlook was still deeply uncertain, or maybe pushed them higher on optimism. It sort of canceled things out.
Interesting. So geopolitics trumped the Fed pivot for oil that day.
It seems that way. It's a reminder that not all assets react purely to monetary policy. Sometimes external factors are more potent, or at least complicate the picture.
And gold. That's often seen as a traditional safe haven, but also sensitive to interest rates. How did it fare amidst this mix of lower rates but much higher risk appetite? Sounds like it might have been caught in a tug of war.
You've hit on the perfect analogy. A tug of war. The price action in gold was pretty ambivalent, highlighting its complex role as an asset in the current environment.
What did the price do?
Gold futures experienced volatile trading throughout the day. They fluctuated significantly between approximately $3,327 and $3,422 per ounce, ultimately closing around $3,370 per ounce. So up a bit, but very choppy.
Right. Why such ambivalent price action for gold? It seems like lower real rates should be good for it.
It does, and that raises an important question the analysis tackled. It's caught between two powerful opposing forces. On one hand, a dovish Fed and the resulting decline in real yields are fundamentally bullish for gold.
He said it's a zero-yield asset.
Exactly.
Yeah.
It becomes more attractive when the opportunity cost of holding it, meaning the interest you're not earning on other investments, is lower. So lower real rates help gold.
Right.
But the powerful risk-on sentiment that fueled the equity rally can simultaneously reduce demand for traditional safe haven assets like gold. Capital flows aggressively toward riskier, higher return investments instead.
Selling gold to buy stocks.
Potentially, yes. It shows how even in clear macro shifts, individual assets have their own complex dynamics at play. It's not always the simple correlation, which is precisely what deep research helps us understand, moving beyond simplistic rules of thumb. 6.3 volatility, the fear gauge recedes.
And finally, what about the fear gauge of the market, the VIX? What did its movement tell us about overall investor confidence and the unwinding of risk after Powell spoke?
The VIX, the SIBO Volatility Index, often referred to as the market's fear gauge, predictably declined throughout the day.
As fear went down.
Exactly. This reflects a clear increase in investor confidence and a corresponding reduced demand for portfolio insurance, like put options. People felt less need to hedge.
Where did it end up? Do we know?
Having closed at 16.60 on Thursday, reflecting the week's anxieties, the VIX fell significantly in tandem with the market's rally. While a definitive closing value for August 22 isn't available across all the sources consistently, a strong drop into the mid-14 to low-15 range is strongly implied by the day's robust market performance and the rapid unwinding of those hedges we talked about.
So a noticeable drop.
Oh, yeah. The drop in implied volatility from that 16.60 level on Thursday down towards the mid-14s serves as the final confirmation of the risk-on cascade.
Ties it all together.
It really does. It tells you that investors collectively felt safer and were less inclined to hedge against future downturns, trusting the Fed's signal and the apparent shift in policy trajectory. This is another key piece of the puzzle that our deep research connected to paint the full picture of the day's cross-asset reaction. 7.1 synthesis of the day's events.
Okay, so bringing it all together now, pulling all these different threads, the speech, the stocks, the bonds, the global reaction into a cohesive narrative. What's the big overarching takeaway from this truly pivotal day on August 22nd, 2025? What's the ultimate insight for our listeners from all this deep research?
I think Friday was a clear and powerful demonstration of the modern market's acute sensitivity to central bank policy. It's a relationship that deep research continually emphasizes, and this day was a prime example.
The Fed still rules the roost.
In many ways, yes. The sharp reversal from a week of persistent losses into a broad-based risk-on rally was not just some random knee-jerk reaction. It was a direct and, you could argue, rational response to the wholesale repricing of future interest rate expectations following Chair Powell's dovish commentary.
Not just sentiment, but fundamentals shifting.
Exactly. The rally wasn't merely a superficial relief bounce. It was fundamentally underpinned by a tangible shift in valuation metrics driven by those lower discount rates we discussed. And it was confirmed by that classic rotation into rate-sensitive and cyclical sectors.
All the pieces fit together.
They did. The synchronized movements across equities, bonds, and volatility provided a textbook example of a market digesting a significant macro catalyst in real time. For you, this is how deep research helps connect all those seemingly disparate pieces, showing the intricate, often immediate dance between policy and market reaction and giving you a comprehensive understanding of how these forces unfold. 7.2. The path forward data is king.
Okay, so the market has spoken loudly, pricing in a high probability of a September rate cut, and that seems to be the consensus now. But what's next? What are investors, having digested this pivot, now primarily focused on? Where does the deep research direct our gaze for the coming weeks?
Well, given the aggressive pricing in of that September rate cut nearly 90%, remember the market's focus now shifts entirely to the next two pivotal data releases.
For sure.
The Consumer Price Index, or CPI, for the latest read on inflation, and the monthly employment report, the jobs number.
Data dependency is back in focus.
Absolutely. These reports now serve as the final, critical gatekeepers for the anticipated policy easing. A surprisingly hot inflation print or an unexpectedly strong jobs number could very quickly force the market to rapidly unwind its dovish expectations.
And that could cause volatility.
Significant volatility, yeah. It could trigger a swift reversal of Friday's gains. Conversely, data confirming economic softness, particularly in inflation or jobs, will likely be seen as a green light for the Fed to proceed with easing, reinforcing the current market sentiment.
So all eyes on CPI and jobs.
It's all about the data now. Data is king.
And beyond the Fed data, what about corporate earnings and the ever-present AI narrative? That's been such a powerful force this year. But is there renewed scrutiny now after the massive run-up in those stocks, people getting skeptical?
That's right. Beyond the Federal Reserve's immediate actions and the upcoming macro data, the market's attention will also be squarely focused on upcoming corporate earnings, particularly from artificial intelligence bellwether NVIDIA, which, according to the sources, is scheduled to report next week.
A huge report for the market.
Massive. After a huge, almost unprecedented run-up in AI-related stocks that has propelled the market for much of the year, investors are exhibiting renewed skepticism. You can feel it in the commentary.
Show me the money time.
Exactly. There will be intense scrutiny of corporate results for tangible evidence of profitability and concrete return on investment from the massive AI capital expenditures we've seen. It's not enough to just talk about AI anymore.
And there was that MIT report mentioned in the sources.
Yes, that raises an important question. A recent MIT report, highlighted in your sources, revealed that a staggering 95% of surveyed firms have yet to see meaningful returns on their generative AI investment.
95%. Wow.
That adds significantly to the cautious sentiment. The bar for what companies need to deliver to justify these elevated valuations is incredibly high now. And for you, this is where the quality of deep research into corporate fundamentals truly matters, because the macro tide, however strong, won't lift all boats equally without fundamental justification.
Companies have got to prove the AI story with real numbers now.
They really do. 7.3 risks to the outlook.
Okay, even after such a positive and powerful day, no market outlook is complete without considering the risks. What are the potential pitfalls, the unforeseen elements that could derail this rally and challenge the market's current optimistic outlook? What did the deep research flag as key concerns?
Yeah, there are definitely several critical risks to consider, and our sources did a good job analyzing these potential headwinds. Firstly, there's the significant risk of Fed misinterpretation.
We talked about that nuance.
Exactly. The market, in its enthusiasm, clearly embraced the most dovish interpretation possible of Powell's nuanced speech. If subsequent Fed speak from other committee members, or maybe the upcoming critical data, forces Powell or the Fed to walk back this perceived dovishness,
Then disappointment sets in.
right. The resulting disappointment could trigger a sharp and painful sell-off as the market rapidly reprices its rate expectations downward again. That's a classic market head fake scenario. The market could have gotten ahead of itself, assumed too much too quickly.
Okay, risk number one, misinterpretation. What else?
Secondly, persistent inflation remains a stubbornly present concern. We can't forget that. The underlying risks of sticky services, inflation, things like rent, healthcare, which are less sensitive to commodity prices, and rising producer prices, which can eventually feed into consumer prices, they haven't been fully vanquished.
Inflation could rear its head again.
It could. A reacceleration of inflation would put a Federal Reserve in an extremely difficult position, forcing it to choose between supporting a weakening labor market and fighting resurgent price pressures. That's a very challenging balancing act for any central bank, and one that could lead to policy whiplash and market confusion.
Caught between a rock and a hard place.
Pretty much. And global factors, as we've seen, can always throw a wrench in the works, despite the U.S. being the primary driver here.
Right, the external risks.
Indeed. Finally, a host of background geopolitical and trade risks remain potent and ever-present. Ongoing trade policy uncertainty, particularly with China, and geopolitical flashpoints such as the protracted Russia-Ukraine conflict or those lingering India-China border tensions, these could flare up at any moment.
Ever know when those might escalate?
Exactly. Such events have the potential to disrupt the current positive sentiment, inject fresh volatility into the market, and shift capital flows dramatically, regardless of what the Fed wants to do. It's a complex global mosaic that requires constant monitoring and deep analysis to fully understand. These external shocks are always the wild cards in any forecast. Hashtag outro.
So wrapping this all up, you've seen how a single speech from the Federal Reserve Chair can truly reshape the entire market landscape in, well, almost an instant. The Federal Reserve, through Chairman Powell's carefully chosen words, has effectively given a green light, or at least a very strong yellow one, for a potential easing cycle.
Open the door.
But as we've explored through your sources in this deep dive, the road ahead is paved not just with optimism, but with crucial data points and the ever-present potential for surprises, both good and bad.
That's right. And the broadening of market leadership into small caps and value stocks, moving beyond just the tech giants, that is a genuinely constructive sign. It suggests an underlying health and broader foundation for the bull market, potentially.
A positive signal from the internal.
Yes. However, as we've discussed extensively, vigilance is absolutely key. You, as a dedicated learner absorbing all this, should now appreciate the intricate interplay of central bank policy, incoming economic data, geopolitical events, and even individual corporate performance in shaping these massive market movements.
It's all connected.
It really is. This comprehensive approach, rooted in deep research, is precisely what helps you navigate these complex, dynamic environments with greater confidence.
Absolutely. Now, as you digest all of this, consider this final provocative thought we want to leave you with. In a world where central bank words hold such immense, almost immediate power over markets, is the market truly responding primarily to fundamental economic realities anymore? Or has it become increasingly a creature of policy expectations, always trying to front-run the Fed's next move?
A fascinating question.
And what does that fundamental shift potentially mean for how you approach understanding the economy and your investments in the long term, moving forward from here? Something to chew on.
Definitely food for thought.
Thank you for joining us for this deep dive into the pivotal events of August 22nd, 2025. Make sure to keep a very close eye on those upcoming CPI and jobs reports. They are absolutely the next crucial pieces of this puzzle.
Critical data points.
And perhaps even delve into the historical context of past Jackson Hole speeches to see how these patterns play out over time. We'll catch you next time for another deep dive.